How can Islamic finance overcome Sharia-compliant liquidity challenges? Imagine trying to manage money without using interest or traditional borrowing methods. That's the challenge Islamic finance faces. It has to stay true to Sharia rules, which prohibit interest and speculative transactions. This makes finding quick and easy ways to handle liquidity tricky. But Islamic finance has been growing rapidly, and it's finding new paths to solve these issues. One major approach is creating Sukuk, or Islamic bonds. These are certificates that representing ownership in assets like property or projects. Banks can turn long-term assets into Sukuk, which can then be sold or traded to raise cash. This helps banks get liquidity without breaking Sharia rules. Developing secondary markets for Sukuk makes them easier to buy and sell, boosting their liquidity. Another solution is developing Islamic money market instruments. These are short-term tools like commodity murabaha and Sukuk based on profit-sharing contracts. They provide Islamic banks with options to manage their cash flow for a few months or a year. However, these markets are still growing and need more regulation and standardization to work well. Islamic banks also benefit from special liquidity facilities offered by some central banks. These are Sharia-compliant short-term funding options, often called Islamic liquidity windows. Countries like Malaysia and some Gulf Cooperation Council nations have these facilities. But in many markets, such options are limited, so expanding these programs can help banks manage their liquidity better. Collaboration among Islamic banks is another key. They can pool their resources through joint funds like musharaka, which means partnership. This way, banks with surplus funds can share with those needing liquidity. It reduces reliance on non-Sharia methods and helps build a more stable market. Using technology also plays a big role. Digital platforms and blockchain can make trading Islamic financial instruments faster, safer, and more transparent. This improves the secondary market for Sukuk and other assets, making liquidity easier to access. Real-time transaction systems and APIs connect banks more efficiently, speeding up the process of matching funds. Finally, innovative Islamic endowments like Cash Waqf are gaining attention. These are funds set aside for charitable purposes but invested in Sharia-compliant ventures. They create a steady pool of funds that can be used for liquidity needs, while also generating returns for the community. This approach attracts investors who want to support ethical projects. In the end, solving liquidity challenges in Islamic finance involves a mix of creating tradable assets, developing short-term markets, expanding interbank facilities, encouraging cooperation, and embracing new technology. With supportive regulations and clear standards, these strategies help Islamic finance grow sustainably while respecting its core principles.